buy the rumor, sell the fact, but the trend is up. You can't be disappointed in $4,750 gold. This is a major uptrend. We're not even close to the highs, and we're not even close to the highs in silver. So buy some silver. So all of this news is bullish for gold. Stagflation, that's going to get worse on both sides. Economy's going to get weaker. Inflation is going to get stronger. The dollar got beat up on the week. Dollar index settled about 98.5. And so I think people sold into the gold rally. But it's the initial knee-jerk reaction that I think is significant, the way traders are now reacting to the news. And it's all keying off of the Fed because the markets have it completely backwards. Oil, if anything, will cause recession, not inflation. Why? Because if people have to pay more for energy, they have to cut back on other things. Most of the demand destruction is in discretionary purchases. If the Fed did nothing, oil prices, energy prices would go up, other prices would come down, and the overall price level would stay the same. But anyway, so all of this news is bullish for gold. Stagflation, that's going to get worse on both sides. Economy is going to get weaker. Inflation is going to get stronger. The Fed is on hold until it eventually cuts because it will be forced to cut by all the political pressure building because of the economy. The weakness in the labor market, the weakness potentially in the stock market, and the Fed is going to excuse, once again, the increase in prices. It's going to ignore money supply, ignore its balance sheet, which is the real tell on inflation. And it's going to claim that it's temporary, it's transitory, it's due to the war, it's a lingering effect of tariffs. We're going to look through that because we have bigger problems, and gold is going to go ballistic. The dollar is going to tank. So before that happens, again, to my customers of Schiff Gold, keep on buying. You know, gold is not going to stay below 5,000 for long. Right now, it's below 47.50. Buy gold this weekend. Buy silver at 75 and change. Remember, we blew through this $50 resistance. We're not going anywhere near that. The support, obviously, is now just below 70, but like 75. We are going to take off in the price of silver. This is the best environment.
The market keeps betting on a soft landing while the data quietly screams stagflation. As Peter Schiff points out here, weakening growth alongside rising inflation creates a policy trap where the Fed is pushed toward rate cuts despite persistent price pressures. That's the exact environment where currencies weaken and hard assets historically outperform. Yet investors are still pricing temporary inflation narratives, ignoring balance sheet expansion risks. If policy shifts under pressure, the repricing could be abrupt across equities and bonds. Next, Peter Schiff unravels why this setup could drive gold and silver much higher.
The sell-off, I think, was very healthy. We did get some people that kind of jumped on the bandwagon earlier this year when gold and silver prices were skyrocketing. Gold was over 5,500. Silver was 120. We got some short-term speculators. They've been flushed out. So I think we've cleared out a lot of that excess baggage, and the bull train is going to keep on riding. Some people, I think, now, again, they're going to have to get much higher prices. They got scared because gold pulled back. Oh, there was a war and gold went down. Yes, because it went up so much in anticipation of the war. So there's a buy the rumor, sell the fact, but the trend is up. You can't be disappointed in $4,750 gold. This is a major uptrend, and we haven't seen the highs. We're not even close to the highs, and we're not even close to the highs in silver. So buy some silver.
What looks like weakness is often just leverage getting flushed out before the next leg higher. As Peter Schiff points out here, the drop from $5,500 gold and $120 silver likely cleared short-term speculators who chase momentum without conviction. That matters because sustainable trends are built on stronger hands, not fast money. The buy the rumor, sell the fact dynamic around geopolitical events shows how crowded trades unwind quickly. For investors, this resets positioning rather than ending the trend, especially in inflation-driven cycles.
So gold ended the week on a down note, was down about $18. It was positive and negative throughout the course of the day. I kind of ended the day near the lows, actually, but not quite on the lows. But gold settled at around $4,745 an ounce, up just under 2% on the week. Silver had a better week. In fact, it had a better day. It closed up about 55 cents at 75.76, well off the high of the day. But silver up 4.75% on the week. And the mining stocks also had a good week. The GDX was up 5%. But everything was up. And the main rally was Wednesday. Now, gold actually was up as soon as the tacos were served on Tuesday night. Gold futures, shot up. And gold was up about $120 an ounce. And by the time the U.S. markets opened on Wednesday, gold had paired those gains to about maybe $80. And then it ended lower on the day. Gold was down on Wednesday when everything else was up, including silver. But the Dow had a big gain, up over 1,000 points. I forget exactly how many. But on the week, the Dow ended up 3%. So not as much as gold stocks, but a nice move. The NASDAQ was up 4.2% on the week. Even Bitcoin had a rally. Bitcoin was up about 5.5%. So actually pretty good. It beat silver, beat gold stocks. Of course, Bitcoin is still, barely above 70,000. I think as I'm talking, it's around 72, maybe 73,000.
They're calling this a strong week, but the market quietly rotated risk right under everyone's nose. As Peter Schiff points out here, gold gained under 2%, while the NASDAQ jumped over 4%, signaling capital chased risk, not safety. That $120 spike in gold getting sold into tells you institutions use strength to exit, not accumulate. Meanwhile, miners outperforming gold by 5% hints at speculative positioning, not conviction. This divergence matters. When safe havens lag during uncertainty, it usually reflects liquidity, chasing momentum, not stability. Next, Peter Schiff discusses why this rotation may be completely misread by markets.
73,200, so a little higher. Still below the average cost of strategy, but back above 70,000. But I don't think it'll stay above 70,000 for long. The dollar got beat up on the week. Dollar index settled about 98.5, and it was above 100. It closed last week at about 100.2. So the dollar down across the board on the ceasefire. Treasury yields were down, but just barely. The yield on the 10-year Treasury dropped to about 4.3 from closer to 4.4. And the 30-year yield was down even less, barely down. It closed at 4.92. I think it was maybe 4.95, 4.96 the prior week. So the spread between the 10 and the 30 widened a little bit on the week. The big move, of course, was oil. Oil prices were down sharply on the week. I think they closed a week ago Friday. I didn't do the Schiff Gold wrap on Friday. I did the general podcast on Friday from my boat. And so you should have seen that one instead of the official Schiff Gold video. But oil closed that Friday at 112 because Trump had been raising the level of the war with threats against Iran, which he increased over that weekend, including on Easter Sunday. And I talked about that on the podcast I did on Friday. But so oil closed at 112 on heightened tensions. And when all those tensions were alleviated, at least temporarily, on Monday morning, or Tuesday, not Monday morning, on Tuesday night, Taco Tuesday, oil fell sharply. So it closed on the week about $96. So off about 15% on the week. But significantly, we're not that far below 100. Oil is about where it was 2 weeks ago. So all oil did is it rallied big when Trump ratcheted up the tension and then came back down when he dialed it back. But if you look at where the price of oil is now, it's still 50% higher than it was before Trump started the war at the end of February. And we're not going to get the type of relief that the president is promising from the end of this war, if it in fact does end. The reaction to gold, the immediate reaction where gold rallied on peace and it was selling off on war, is the opposite of what people would expect. Normally, if there's a war, if there's bigger problems in the world, people buy gold as a safe haven. And when, the temperature cools and the threat diminishes, then they move out of gold. But that's not what happened. Now, I think one of the reasons that gold surrendered its Taco Tuesday night gains is because there was so much strength in the overall stock market. People were not attracted to the safe haven of gold when they were so risk on with the NASDAQ.
Oil didn't fall because risk disappeared. It fell because positioning got crowded and reversed fast. As Peter Schiff points out here, oil dropped nearly 15% in a week, yet still sits roughly 50% above pre-war levels, which markets are conveniently ignoring. The dollar slipping below 99 while yields barely moved tells you this wasn't a macro reset. It was a sentiment flip. Gold falling during geopolitical tension breaks historical behavior, suggesting traders are pricing Fed reactions, not reality. That's a dangerous shift in market logic. Next, Peter Schiff unravels how this mispricing ties directly to Fed expectations.
And so I think people sold into the gold rally. But it's the initial knee-jerk reaction that I think is significant, the way traders are now reacting to the news. And it's all keying off of the Fed because the markets have it completely backwards. They think that the high oil prices keeps the Fed on hold and takes away the much anticipated and highly desired on the part of investors, like a drug addict craves drugs, rate cuts. And so if high oil prices are what's delaying the rate cuts, then everything that benefits from rate cuts goes down when oil goes up. And so that's gold is a perceived beneficiary of rate cuts. Silver, stocks, crypto, and all the assets that do well when the Fed cuts rates. Foreign currencies, they all were going down when oil prices were going up, and the reverse when oil prices were going down. But this is not true. Gold and silver are going up regardless of what the Fed does with rates. Because no matter what the Fed does with rates, real interest rates are going down. Even if the Fed raises rates, which I don't think they're going to do, but even if they do it, it won't be enough to close the gap between the increasing inflation rate and the Fed funds rate. So no matter what, real interest rates are going way down. Inflation is going way up, and it's not about oil. Oil is not the reason that we're going to have higher inflation.
Markets aren't trading reality. They're trading a flawed story about the Fed. As Peter Schiff points out here, investors are treating oil spikes as a delay to rate cuts, when the bigger issue is real rates collapsing regardless of Fed action. Even at 4.3% on the 10-year, inflation pressure is outpacing yields, compressing real returns across assets. That means gold isn't just a rate cut trade. It's a currency debasement hedge. The mistake here is thinking policy control equals economic control, which history repeatedly disproves. Next, Peter Schiff discusses why oil isn't the true driver of inflation risk.
Oil, if anything, will cause recession, not inflation. Why? Because if people have to pay more for energy, they have to cut back on other things. Most of the demand destruction is in discretionary purchases. Yes, you could cut back somewhat on your energy consumption, but you can't turn it to zero. But other items, you don't have to buy at all. You don't have to upgrade your iPhone. You don't have to take a vacation. You don't have to buy the new car. You don't have to buy a new suit of clothes. You can make do with what you've got if you're spending too much money on heat and electricity and gas and food. So those higher prices don't cause inflation. It's only people who have no idea what inflation is that think inflation is rising prices, that think that it's higher oil prices that are inflationary. They're not. They don't cause inflation. The government causes inflation. What will cause more inflation is not the fact that oil prices go up. It's the fact that the Fed ends up printing more money to stimulate the economy because higher oil prices hurt the economy. And it's that new money printing, rate cuts, quantitative easing. That's why we have inflation. It's not oil prices going up. It's what the Fed does in response to oil prices going up. That's what makes all prices go up.
Higher oil prices don't just hit inflation. They quietly choke consumer demand where it matters most. As Peter Schiff points out here, when energy costs rise, households don't spend more overall. They reallocate, cutting discretionary sectors like travel, autos, and retail. That's where recession risk builds first, not in headline inflation prints. The critical piece investors miss is the second-order effect, policy response. If the Fed steps in with rate cuts or liquidity support, that's when broad inflation accelerates across the system. This shift from demand destruction to monetary expansion is where portfolios get blindsided. Next, Peter Schiff unravels how this policy reaction becomes the real inflation engine.
If the Fed did nothing, oil prices, energy prices would go up, other prices would come down, and the overall price level would stay the same. Now, the overall standard of living would go down because people would be spending more money on energy and less money on other things. But when the Fed prints a lot of money, then we pay more money for everything. It's not just the price of oil that goes up, it's the price of everything else that goes up. And that's why gold and silver prices are going to keep rising. In fact, let us look at the economic data that came out today that all points to inflation. And by the way, before I even get to that data, the post office came out today and announced that they're increasing the price of a first-class stamp. And so these are the forever stamps. So the new price is going to be 82 cents. That's a 5% increase from the price last year. In 2020, the price was 55 cents. So you're up 49% in 6 years in the price of a stamp. That's 8% a year. 8%. I think that is a better government indicator of the cost of living than the CPI.
The real inflation signal isn't CPI. It's hiding in plain sight in everyday costs people can't avoid. As Peter Schiff points out here, stamp prices rising 49% since 2020, about 8% annually, directly contradict the official inflation narrative of roughly 25% over the same period. This gap reveals how policy-driven money expansion quietly erodes purchasing power beyond headline data. Investors focusing only on CPI risk underestimating real inflation pressure building across sectors. When essentials reprice faster than reported metrics, asset allocation decisions become dangerously skewed. Next, Peter Schiff unravels why official inflation data continues to mislead investors.
The government lies about the CPI. They don't lie about what they charge you to buy a stamp. So the government is telling us that inflation is, whatever it is. I forget what it acknowledges, maybe 25, 26% over 6 years based on the CPI. But the post office, the price of a stamp has risen by double the official rate of inflation. Now, yes, the post office is obviously not the most efficient group. But, I'm sure that price increase doesn't even cover. They're probably losing more money with a 50% increase in the price of a stamp. They probably haven't raised it enough. So I would say that given all that, it's a more reliable indicator. In fact, I remember when the post office first introduced the forever stamp, my advice to a lot of people, if they didn't have a lot of money, was just to load up on these forever stamps, because I thought they were a better investment than government bonds, because it's basically backed up by the ability to mail a letter. But I said, if you buy a bunch of these stamps and hold on to them, the return on your investment is good, because you can always sell these stamps.
A government that understates inflation but steadily raises its own prices reveals more than it admits. As Peter Schiff points out here, when stamp costs double the CPI trend, it signals structural underreporting rather than isolated inefficiency. Even if the postal system is losing money, persistent price hikes reflect real cost pressures flowing through labor, logistics, and energy. For investors, this matters because bonds priced off official inflation may deliver negative real returns over time. It reframes what safe yield actually means in portfolios exposed to policy distortion. Next, Peter Schiff discusses how this distortion creates overlooked investment opportunities.
You can sell the forever stamp for the current price of the stamps. There's a market for them. So you can have, if the price is up 50% in 6 years, you got a 50% gain on your forever stamps. You had no downside risk. The stamp couldn't go down. I mean, there's no chance the post office was going to lower the price of a stamp. They've never done that. And so all you could do is stay even or go up. So better than buying tips even. It was the best deal the government gave you, was a forever stamp. Not that, I even use that many stamps these days. I mean, the only reason I didn't even load up on them myself is that I barely use them. I maybe I put a stamp on a letter once a month, if that, But I think it's ironic, too, where the government's trying to tell us there's no inflation. Well, look at the post office. But anyway, we got a lot more data points that came out. So we got the CPI number that came out today. I got it here. Or is it? This was the March CPI. So this is the first month that included the increase in energy prices. Although, a lot of companies, they take a while before they pass on those price increases. So a lot of it didn't hit the consumer prices in March. It may have hit producer prices. The consumer might not feel the pain until April. So we'll get those numbers in May.
An asset with no downside sounds absurd. Yet this example exposes how predictable policy-driven inflation really is. As Peter Schiff points out here, a 50% gain in stamps over 6 years isn't a fluke. It's a direct reflection of steady price escalation the market already anticipates. But the bigger insight is timing. March CPI barely captured energy cost increases, meaning inflation data is lagging reality by at least one cycle. Investors relying on backward-looking indicators are always late to reposition portfolios. This delay distorts risk pricing across bonds, equities, and commodities. Next, Peter Schiff shows how this lag feeds into larger inflation trends.